right. The next small cap big idea is SRG Global. It's in maintenance, mining services, and engineering construction. So not super sexy, right? So I caught up with Harry Watt from Market Matters. It's his pick, and began by asking if it is the sector or the particular stock that's attractive.
The sector broadly is in a pretty reasonable spot, digging off those three areas of SRG. They've all got their own little tailwinds at the moment. I think there is, a bit of a sector tailwind coming through for SRG. But in saying that, I think SRG is our main pick for a few reasons. I think it's the cheapest in the space. It's got really good growth coming through, and I think we're back in this management team basically to continue to execute what they have been doing, what they did in FY23. We're expecting that to continue through FY24 and beyond. They've done really well in M&A and integrating that side of things as well, and just continuing to win more contracts. So, while there is a bit of a sector tailwind, SRG not being the sexiest sector going around, SRG themselves, I think there's a few reasons why we like that one in particular.
Yeah, well, we'll go through that then, because winners are grinners when it comes to contract wins. What is it about the nature of the contracts that SRG Global is winning that makes it more attractive than others in the space?
They've got blue chip clients, so you think Fortescue, BHP, South32, a couple of their big clients there. Really blue chip top 20 ASX listed stocks. They've also got a number of government contracts in their books as well, both here in Australia and in New Zealand. These contracts, these clients of theirs, they're not falling over tomorrow. They're really well stabilised businesses that do need SRG's product, do need SRG services. So, in that respect, really key for SRG in terms of stability of earnings. They've also got contracts that run sort of upwards of 5 to 10 years as well. So you're thinking about contract wins, you're thinking about incremental revenue through the next few years as well. So really stable revenue stream coming through for the business, and that's something that we're really attracted to. They've got long-standing relationships with these clients that they might pick up a small contract on a project on a mine site, whether it's with Lendlease on a construction site as well. And then they tend to continue to win contracts with those companies and with those assets as well. So it just continues to build on that revenue stream and that longevity of revenue as well, which is really important in this space.
Yeah, I think I was reading that with Transpower in New Zealand, their relationship goes back about 30 years. But on the revenue piece, is it wrong to consider some of that revenue recurring? Like, is it ARR?
I wouldn't say it's wrong to consider it ARR. Probably about 70% of the business, about 60 to 70% of that business, I would call recurring revenue. So consistent revenue, long-term contracts. When these contracts come up, SRG is in a really good place to continue that relationship as well. So while it's might be a 5 to 10 year contract, it probably works out to be 20-year plus relationships with these clients. Like you said, Transpower, it's a 10-year contract, but they've already been working with them for some time as well. So, these contracts come up, you might see some risk around that revenue piece coming through, but they do tend to, more often than not, continue to win contracts on those bases as well. And, having that long-standing relationship helps a great deal for SRG.
You mentioned acquisitions. Do you want the company to continue to be acquisitive, or would you be happy for them to really focus on their main markets being Australia and New Zealand?
They've picked up a really good M&A piece in ALS, Asset Care. So I think that was a really key bolt-on for SRG. It just continues to add to that incremental revenue increase. They've got really low gearing at the moment, so their net debt to EBITDA is sitting at around about half times, so 0.5 times. That's really low for SRG and for this space more broadly. I don't want them to see them be too aggressive with M&A. I think these little small bolt-ons, can incrementally help. But keeping that net debt figure down at the moment where interest rates are, keeping that interest cost quite low for SRG, that will be important moving forward. There will be opportunities to pick up distressed assets in the coming years, I see. So having that balance sheet flexibility, not being too aggressive in the space, but keeping an eye to the ground, or keeping an ear to the ground in terms of opportunities that do come up, I think can be incrementally positive for the company as well.
So correct me if I'm wrong, but for FY24, SRG has guided to underlying EBITDA growth of around 20%. I mean, what has to go right for that to be achievable? Or in your view, is that easily achievable when you consider the contract wins that they've been coming through with?
Well, yeah, you take a look at FY23, they won over $1 billion of contracts. So far this year, they're sitting on about 260 mil worth of contracts already. So, their run rate's a little bit light on versus last year, but that's to be expected with a, standout year that they had last year. I think last year's contract wins are really supportive of what they expect to see with that EBITDA growth of about 20% or more. I think that would probably prove to be conservative if they can continue on it like they have been. So overall, I don't think there's a great deal of risk in terms of them missing EBITDA expectations. If you have a look last year, they upgraded EBITDA expectations late in the year as well and still beat them. I think that's a good sign of momentum with those earnings coming through, that this 20% growth in EBITDA probably will prove conservative come the end of this financial year.
Okay, so if I think about some of the headwinds, you've got ongoing labor costs, cost pressures in general, I suppose, but then a pretty favorable macroeconomic environment for this type of spending. So is that right? How do you view the headwinds versus the tailwinds from the broader macro environment for SRG?
Yeah, I think you're exactly right. Labour cost is probably the main risk around SRG's execution here. Maybe that's something they have to look at M&A for, just to get more expertise in the door for the company. But overall, they're doing really well in terms of maintaining margins, putting through those cost rises into their contracts, and managing to stabilise their earnings growth as well. So overall, there is some risk around that labour sort of piece. We are seeing massive immigration that could help SRG pick up some key personnel in terms of executing the contracts that they've got on the books. So overall, there is a little bit of risk on that side of things, but at the moment, we've proven that SRG's proven that they can continue to tick those boxes. And from our perspective, we're back in management just to stay the course and see those contracts through and see those margins maintain at least where they are.
So they have lifted the fully franked dividend, but is it right as well, Harry, to say you shouldn't really rely on dividends from a company like this?
Well, yeah, they have been pretty consistent with dividends recently, but obviously this space fluctuates quite a fair bit. We saw cash flow conversion last year roll off a little bit, but they still managed to pay a pretty reasonable dividend. We probably expect around about a 6% yield out of this stock moving forward. And that would be on about a 60% payout ratio as well. So not stretching the balance sheet, not stretching their earnings in terms of paying that back to shareholders. I'd probably like to see them continue that stream of revenue, continue that stream of dividends back to shareholders moving forward as well. I think that's just a key valuation reason for SRG, and it's a reason why we hold it. Having that safety net of having some dividends coming through that door in current years and future years. That's a big reason for us to hold this stock, given where the market's trading at the moment. So some risks around the market more broadly, income becomes a fairly important part of returns, and it's a big reason why we like SRG.
Yeah, well, can you speak to us then about valuations finally? Because you said you're happy holding it, but would you be buying it right now? I mean, is it trading at a discount to where you think the share price could be?
It's trading on about 3.5 times EV to EBITDA, with 20% growth sort of built into those numbers. I think that's pretty, conservatively priced. It's something that we like around here. It's something we'd be keen to add to. We have seen this share price start to turn a corner in recent weeks as well. So, there are other people in the market with that same sort of viewpoint. You stack it up against peers, it's trading at a decent discount to that. It's trading at a decent discount to where it has historically been on about 4.5 times EV to EBITDA, forward looking. So from our perspective, it's a stock that we like, continue to hold, and would add to on a pullback, and would be adding to portfolios if we didn't own it. So ticks all the boxes to be holding it in our portfolio at the moment. Okay,
and Harry, just final question. If you had to rate its riskiness, sort of 1 to 10, 5 being the middle, 10 being most risky, like how risky of an investment is this, just for our viewers?
So broadly speaking, the sector, it tends to be a more high-risk sector. So it's probably sector-wise, it's more on like the 7 to 8 sort of scale of that, risky 0 to 10 level. But SRG at the moment, given their long-term contracts, given their stability of revenue, and their foresight and their ability to see revenue over the next few years as well, probably pulls it back down to that sort of 5 to 6 range as well. So, sector-wise, a little bit more risky, a little bit more ritzy, does sort of come and go with economic cycles more aggressively than most. But SRG at the moment is really well placed and really good visibility, sort of pulls that back down to a sort of mid-range risk level